Hello, everyone. I'm Trent Jacobs, the digital editor of the Journal of Petroleum Technology at SPE. I hope everyone tuning in is staying safe and healthy. Today, we're going to be speaking with Christopher Page, who's a senior analyst of oil market research at Rystad Energy. Christopher is going to provide some context on this week's U.S. oil price crash, what it means for the future. Christopher, are you with us?
Yes. Thank you so much.
Thanks for joining us. Thanks. So this week we saw WTI prices go negative in a big way. What were the market triggers there, and what are the short-term impacts that you're looking at?
Right. Yeah. So this negative price crash really reflects the shortage in global storage that the oil market is coming up against. So currently, Rystad Energy estimates that there's approximately 400 million barrels worth of global crude storage, and we estimate that stocks are building by approximately 26.5 million barrels per day. So we're anticipating that if these tanks fill to 95%, which is where we believe is kind of a reasonable level for storage, that global storage could fill within the next 2 to 3 weeks. And so when you look at the prices for the contracts that were being delivered on May 20th, that were closing on Monday and yesterday, that a lot of traders who had a paper contract for the crude didn't actually have physical storage lined up for the crude that they bought. And so they needed to quickly either find buyers who had access to that physical crude space. And so that's really what led to that negative price crash.
So it's fair to say that we look at that negative pricing, that wasn't every barrel in the world that was priced that way. And so if you take that into account, is it a big deal? How should people take it into context? Is it a blip on the radar and just a sign of our volatile times?
Well, unfortunately, because storage is starting to run out in the U.S., I think we can expect probably to see a similar crash around May 19th of the next month if storage and production isn't shut in, or if the balance isn't solved through that way. Because again, a lot of these paper traders have bought up contracts for crude, but a unique aspect of WTI is that you need to have a physical location for that crude. As of yesterday, WTI at Cushing had approximately 21 million barrels worth of crude storage available. And so if a trader doesn't have access to that physical storage, then they're going to really be desperate. And so I think we'll see prices remain depressed in the month of May and June as these storage tanks start to really fill.
Okay, so let's talk about that. What is the outlook for storage? We're hearing about bottlenecks at Cushing, but how does this situation play out in the U.S. and elsewhere?
Right. So we're estimating that approximately 2 weeks remain in global storage, and China has approximately 300 million barrels worth of storage between their SPR and their commercial crude storage. But we're estimating that not a lot of that will be able to be purchased by the Chinese. So the other main crude storage market is the U.S. And unfortunately, I think that on Monday's negative prices reflect that a lot of the storage is already spoken for or full. And so for producers who don't have access to that physical storage, they're going to need to start to shut in production to balance the market. And then that's just a fundamental reality of the situation right now.
Well, that's one of the biggest topics of the day as well. So on one hand, we have storage running out. We have pipeline companies saying that we're going to cancel contracts on the people who have short-term contracts, and that's forcing on the smaller end shut-ins to already begin. But is there a delay in the shut-ins that are happening in the lower 48 in all of North America, or is that already taking place? What are you seeing there?
Definitely, I think there are delays that production can't be shut off overnight. There's certain legal ramifications of shutting off production in terms of the mineral rights. There are obviously just the strategic and financial concerns of shutting down production that I think no one wants to be the first person who kind of shuts in production or gives up revenue. And so when you look at a lot of these independent U.S. shale players who have significant leverage and debt obligations, that some money coming in is better than no money at all. And so I think that a lot of these players then are really trying to face difficult decisions. There's been discussion that there's going to be costs to restarting production as well, and that there might be diminished production potential from some of these wells if they shut down production. We don't see that necessarily as a significant risk in the U.S. In Canada, definitely that's the case. That many of these reservoirs that in Canada, if they're shut down for more than 60 days, they will sustain damage that will require significant capital investment to start up again. But it's more kind of the strategic decision on the U.S. side.
Okay, thanks. And we want to remind everybody that since you're watching this live, you can send us in your comments and questions. And we've got a couple already. So one of the questions that came in is that we can't stop production now in terms of the United States. So you're describing sort of something that will play out ad hoc, company by company, right, and sort of a graduating program of shut-ins.
Exactly, yeah. So there's been no coordination from the Texas Railroad Commission yet on kind of guiding production cuts, which I think indicates that, yeah, it's going to be done on an ad hoc basis, depending on which producers have access to physical storage, and if they have refineries that are willing to buy their crude. And so I think it's going to put a squeeze on a lot of the smaller players who probably don't have access to that capacity.
I know you're focused mostly on the U.S., but we had another question about the impact in Middle East production. So obviously, we know that OPEC's deal doesn't take effect till May 1st, but to see there, will those cuts take time to take effect? They won't happen either on day one, on May 1st.
Right. Yeah. So Saudi Arabia can actually shut down production quite quickly because of the nature of the wells over there, and so. And Saudi Arabia also has quite a bit of storage available. In 2015, they had upwards of 330 million barrels in their storage domestically, and that's since fallen to about 155 million barrels. So they have 175 million barrels of their domestic storage that they could leverage if they so choose. And so definitely Saudi Arabia, if they want to continue to keep producing the oil that they've committed to cut, and just store it, that could be a definite option. Russia, on the other hand, faces a much more difficult decision because they have 160,000 wells that produce about 60 barrels a day. And so many of these wells, if you shut them off, from our conversations with clients, that they may not ever come back online. And so Russia really faces the difficult decision of, if they do shut in production, that the long-term potential in Russia might never recover. So I think the Middle East itself is well positioned in terms of the storage and geological standpoint, better than Russia. But then there are also other considerations at play affecting Saudi Arabia versus Russia.
Turning back to U.S. shale, we had another question that came in, and it said, what are the risks of shutting in U.S. production? You kind of alluded to some of these concerns, but could you elaborate for us?
Right. So I think that the biggest risks, just of course, are the financial and strategic risks that if you shut in production, defaulting on this debt is a very real concern for a lot of producers. Before difficult environment, even before coronavirus and the Saudi-Russian price war, because just many of them were highly leveraged and needing to continue to grow production to service their debt. And so that's definitely, I think, the biggest concern. There is the potential risk to certain wells, just in terms of damage if they do shut in production. We don't, again, see that as a significant risk right now. And then there's also just the concerns that there may be some legal ramifications depending on the mineral right of shutting in production. So they have to be careful about those as well.
Right, a lot more nuances in the U.S. shale sector, it seems, than some other region here. And it's like, can we consider the price drop a good event if it eliminates small and inefficient producers from the marketplace? Would this make the market more stable and controllable?
Well, I think that, when you have OPEC controlling in the 90s and 2000s when they're producing 60 and 70% of the total global production, and that there's benefits and negatives to that. On the positive side, that you're not going to see this price crash because OPEC can coordinate the market probably better than countries that have a free market in place, such as the U.S., Canada, and Norway. But on the other hand, then there's potential for price spikes. So I mean, I think that there's always positives and negatives. We do see consolidation in the sector among some of the bigger players like Chevron and Exxon, that definitely that they've proven themselves as effective operators, that they can really bring costs down on a per barrel basis. And so that, I think, will be beneficial in terms of at least prices for American production.
Well, Christopher, we got you for just a few more minutes, and I wanted to ask you, another big question here. As we look out at the production, we're talking about shut-ins, and we're watching the rig count fall at a historic pace. So as we look out for the rest of 2020, what kind of production drops are you expecting to see in U.S. shale? And could the U.S. ever reach its peaks from 2019 again, say, in a few years? Is there a recovery on the long-term end?
Well, that's a great question. Our current forecast has U.S. oil production right now at about 12.5 million barrels per day when you include the Gulf of Mexico and Alaska. And we're anticipating that's going to drop to about 11.2 million barrels per day by November. And so definitely we think that there will be a recovery when prices start to recover, but that's highly dependent on oil demand. So, and oil demand, of course, is very unpredictable given the kind of impacts from coronavirus, as well as the broader economy. So our base case is that oil demand will recover in 2020 or 2021 and beyond, and that by 2022 we will see a significant recovery in prices. But of course, it's anyone's guess kind of how long some of these shut-ins from coronavirus might last, and how the demand picture will look in 2021.
Well, Christopher, I really appreciate you sharing your insights and your forecast with us. That's all the time we're going to spend with you today. So we want to let you go, and thank everyone who's been joining in with us, watching live and sending in their comments and questions. The SB is going to keep bringing you these broadcasts to cover various topics over the coming days and weeks. And so to find out about them and bookmark them, keep following us on social media. That way you won't miss any of it. So please stay safe and healthy, and we wish everyone the best of luck out there. Goodbye for now.